I'll start off just by giving us a picture of what's actually happened so far, and then talk a little bit about the economy and where we see the vulnerable parts. I'll wrap up by looking at the Chinese economy and how that's recovered as a picture of potentially how we can expect to see economic recovery. And then I'll combine that into how we're positioning from an asset allocation perspective, and then Nolan will zoom in on fixed income, and Pete Armitage will zoom in on equity from there. So just what's happened so far. I'm gonna breeze through this in the interests of time, but we in the blue line there, we saw the MSCI World down 34% in the 4 weeks from mid-Feb to mid-March. It bounced about 21% since then. The brownish line on that chart is the SA market in dollars. So that dropped about 45% in dollars in those 4 weeks. It also bounced back about 21%. So for the MSCI World, that chart that I brought up there now, we wiped out about 3 years worth of growth. It's taken us back to sort of mid-2017. And for the FTSE, that's wiped out about 6 years of growth. It's taken us back to the beginning of 2014. So just to try and put this into perspective, I've looked at other bear markets and bull markets over history. So I've taken 40 years of S&P data. We don't expect this to be an identical replica. Obviously, each time is different, but as Mark Twain says, there's some sort of rhyme to how these things work. And so looking at 40 years of US S&P data, there were 5 bull and bear markets. The average bull market was about 6.5 years long. The average bear market only just over a year. And in those bull markets, you can expect to quadruple your money on average in the S&P, and during a bear market, you on average lose about a third of it. If we zoom in on the bear markets and compare it to the one we're experiencing now, the S&P is moving around all over the place, but down sort of circa 20%, which is make it a pretty mild bear market by historical terms, and we're about 8 weeks in, and that's also kind of short. I've done a similar analysis for South Africa. So this is the Aussie. We only have 25 years of data, but in that period, we managed to get 8 bull and bear markets. So they happen at a lot quicker than they tend to happen in developed markets. So the average bear market, the average bull market's been about 2.5 years, and the average bear market about 6 months. For context, this one started in January of 2018, so we're over 2 years into this one. So by far the longest we've seen in the last 25 years. The story, though, is similar. So on the way up in bull markets, you tend to more than double your money, and you lose about a third in the average bear market. And then zooming in on this bear market for context, as I say, you lose about your third of your money on average. And this time, despite the fact that we're over 2 years into this, we're only about 20% down. So it's been mild, but excruciatingly long. And then how do they feel? How does it feel to be in a bear market? Miguel Saavedra is a 16th century Spanish writer. He said, forearmed is forewarned. And so if we know kind of what to expect in these bear markets, it helps us be less likely to react irrationally. And so the first chart I want to show you there is the number of positive days we experience in bull and bear markets. So in the blue bars there are bull markets, and roughly only slightly more than half the days are positive, even in bull markets. And in bear markets, only slightly less than half the days are positive. So it's not like markets are always going up in bull markets and always going down. They bounce around all over the place. But the biggest difference tends to come on the right-hand side of that slide there in the extreme moves that we experience. So again, blue is bull markets, red is bear markets, and on the far left, the US, these are big up days. So when the market moves more than 2.5% on a single day, you're about 5 times more likely to see those big up moves in US bear markets than you are in bull markets, and that's somewhat surprising. In SA, that doesn't really happen. And then on the right-hand side of that chart, which is far more obvious, you're much more likely to experience big down days in bear markets. So that's pretty much the norm. So I'm going to spend some time focusing in on economic activity and particularly highlighting the areas that we think are most at risk with this type of recession that we're going into now. This is a chart for US GDP, and I focus on the US not because it's the only economy that matters, but it tends to be the one that has the best data for analyzing. And it's a pretty good proxy for developed markets. Most of the economic activity in developed markets is fairly similar to what's happening in the US. from a construction perspective. And so we can see there that about 2/3 of economic activity is from households' consumption or spending, and the rest is split roughly evenly between private investment and government spending. And if I look at SA, it's pretty similar. By far, the biggest chunk comes from consumer spending, about 60%. And again, the rest is split roughly half between government spending and private investment. So what normally happens in recessions, I've used the last 3 US recessions as an example. So that from left to right there, you've got the GFC in 2008, the tech bubble in the middle in 2001, and on the right, that was the early 90s. We saw an oil shock and a few other things happening. And those little bars in each of those 3 charts represent the contribution to the decline in economic activity from each of those segments of economic activity. And the main thing I want you to take away from this slide is the highlighted red bars, which represent the drag from private investment, by far the biggest drag on economic growth in all of the last 3 US recessions. And that's somewhat surprising given that it's only about 20% of economic activity, but it falls precipitously as confidence declines. And so we see that as the biggest risk to economic growth generally in most recessions. Drilling down a little bit further into economic activity, again, this is for the US. I've drilled into the subcategories, and I've tried to traffic light this tables to show the stuff in red that is at risk of a fairly big drop in consumption or in activity. The green stuff is pretty safe, and then the orange stuff is somewhere in between. And as we saw from the previous slide, we expect confidence to impact private investment, and that's things like building commercial or residential houses, buying new equipment, investing in R&D. Those things are all at risk. The bottom there, the government spending, we expect that to be safe and actually increase with the fiscal stimulus. So that stuff's all fine. And then the biggest component at the top of that chart, consumer spending, I've broken that down a little bit further into these 3 categories. So discretionary spending at the top, non-discretionary and partially. And within discretionary spending, there's a whole lot of orange categories. So things like buying cars and furniture and clothing, those are likely to experience some slightly less activity. The red highlighted sections, so recreation services, that's stuff like going to movies, theme parks, sports events, and food services and accommodation, so things like going to bars, restaurants, and hotels. That stuff is right in the eye of the storm in this crisis, and that represents 10% of consumer spending, so about 7% of economic activity, and that can be wiped out substantially. So that can be a sort of 5 to 7% drag on economic growth. The non-discretionary stuff, buying groceries, paying your rent, paying your utilities and healthcare bills, that stuff's probably fine. And so that's kind of the picture of where we see economic activity playing out over the foreseeable future. How does that play out into the job market? Again, I'll start off with the US. So that's on the left-hand side. This is retail jobs. If I exclude guys that are working at grocery stores and pharmacies, guys that are working at online retailers, you still have about 8% of the US workforce employed in the other part of retail, and that's obviously a little bit at risk. You've got guys involved in air transport, real estate, and the oil services industry. That's about another 3% of employment. And then that massive chunk, 11% of the US workforce are in leisure and hospitality. So that's right in the eye of the storm, and that's part of the reason we're seeing dramatic drops in the number of jobs or the amount of jobless unemployment claims in the US. And we need to get that portion of the workforce back to work quickly. Otherwise, we're going to see the second-order effects of unemployment weighing on economic growth. I've tried to do a similar exercise for South Africa. Obviously, the data is not as granular, but for what it's worth, on the left-hand side there, I've charted the various types of informal employment, which make up about 17% of South Africa's employment. These are temporary workers or informally employed people, and I imagine that those jobs are pretty much at risk. And then on the right-hand side, the other 80% of employment, which is formal, there's obviously some categories that I've highlighted in there that have elements of risk involved in them. So people working in the construction industry, people working in retail trade. We don't have as much granularity here, so we don't know what portion of that is grocery stores and pharmacies. but at least some portion of that is at risk. Hotels and restaurants, that's only 2% of overall employment in South Africa, so not nearly as significant as it is in developed markets. And then there's a bunch of sort of things like other business services. We don't really know what's inside of there, but clearly some jobs at risk. And then on the far right-hand side, another 8% of the South African workforce is employed by private households. So these are domestic workers and the like, and those are certainly some other jobs that might be at risk there. So the good news is that the governments are trying to step into this hole that's been left by the economic activity void of the private sector. And so I've got a chart here on the left-hand side that shows the 6 biggest major economies around the world and how much their governments are trying to step in to plug that economic hole. So those blue bars are billions of dollars. So the US has committed about $2 trillion of government spending to try and plug the hole. In red there, that represents the portion of economic activity for that country. So the US's $2 trillion commitment is about 10% of economic activity in the US on an annual basis. So they're looking to plug a gap that the private sector's left of at least 10%. So that's exciting. Japan, $1 trillion, that's 20% of the economic activity that the government's looking to sort of plug in the short term. And so if we look at this stuff in aggregate, it's about $4 trillion, and that makes up 4.5% of total global economic activity. So that's a big step in the right direction to keep confidence going and to keep economic momentum going. And then finally, I want to touch on China and look at how that recovery is happening. We're about 2 months from the sort of peak of infections there, or from the trough in infections there. And so we want to see how even the economic recovery is there. And the first slide I want to look at is public transport or transportation, people getting out and about in general. So on the left-hand side, those 3 charts there represents public transport in China. On the left, road, that's people traveling in buses that dropped from like 70 million a day to about 20 million a day. Rail and air transportation have also dropped precipitously, 70-80% drops in those number of people using mass transit. The good news on the right-hand side of the chart is it doesn't mean that people are stuck in their houses. So the number of people willing to get out and about using their personal vehicles is back to normal levels. So the blue bars represent vehicles traveling on the roads for the last 6 or 8 weeks in China, and it compares pretty favorably to the same 6 or 8 week period last year. So people getting out and about, just shunning public transport. Zooming in on the air transport transportation. So as I said, it's dropped 70 or 80%. What I want you to take away from this slide is the fact that the trajectory since the reopening of the economy in around March is not improving at all. So there's no signs that people are sort of gradually starting to fly again. And that obviously has consequences for travel and leisure and the economic activity that supports that. Property sales, again, dropped precipitously. It's bounced back a little bit, but not an area that's even close to back where it was. And then on the flip side of that, the positive side is the industrial activity looks to be good in China. So this is the coal consumption by the major Chinese power plants, and that's pretty much back to normal. So heavy industrial activity and industrial activity in general seems to have bounced back to where it was before the crisis. Likewise, this chart takes us through the various forms of shipping in and out of China, and those are at least back to their pre-COVID levels or even higher in some instances. So import-export activity seems to be recovering pretty quickly. So what we've seen is a sharp drop in markets, a big bounce back. It's happened in a short period of time. It's in the context of broader bear markets, pretty short and pretty shallow at this point. Economic activity, we've seen some big areas at risk, but governments are doing well to step into that gap for now. And if we get a picture of how economies can recover once we start seeing movement restrictions limited, we see that as uneven. So industrial activity should bounce back quickly, but service sector is probably going to take a little bit longer. And so what does that mean for us in terms of how we're allocating our clients' assets? Well, this is a chart of how we were allocated at the beginning of the year. So largely neutral on global and versus domestic. We thought the currency was in a fair range. Within domestic, we thought that the high real yields in cash and bonds were pretty attractive. The opposite of that offshore with negative real yields. And so that's kind of where we were positioned. Then you had these dramatic market moves over the last few weeks, and it's pushed our positioning to this next column here. So we had a huge move in the currency, which has meant that on a relative basis, we're now significantly more overweight offshore assets. Within domestic, we saw huge drops in domestic equity and domestic property, and that's obviously meant that the relative allocations to that has dropped dramatically. And this on the right-hand side is kind of where we want to get back to. So we think the currency is attractively valued at this stage, so we want to start repatriating assets. We think that the rest of the risk assets were sort of similarly positioned to where we were at the beginning of the year. The exception is domestic cash, which the real yields have dropped, and so we now think it's better to put that cash to work. The big question is, how do we get back there? So we need to, in order to get back there, we need to actively allocate to domestic equities, to domestic properties. We need to bring some profits back from overseas. And I guess the main question, the main theme that we want to highlight here is we want to do that patiently. So we think that there's still some volatility to come. And so we want to be patiently building our positions back up in domestic equity and bonds and patiently repatriating some of that currency. But we think because of the uneven nature of this recovery, stock picking is going to be critical. So some sectors are going to be much more affected than others. And so the section at the end where Pete Armitage talks about specific companies, that will guide us to a large extent about how we reallocate those domestic risk assets.